Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in on this afternoon of Monday, March 31st, 2025. It is the end of the month, and what a great month for precious metals, for gold especially. Gold closing the month above 31.50. Silver not quite able to close at 35, but hey, that's major resistance at the $35 level. So today in this video, I have talked about this in recent Macro Mondays, and that's talking about the fundamentals of gold miners and gold mining. And people, these fundamentals, they're really, really heating up. They are looking really, really good. And look, mining is cyclical, but the fundamentals being really, really good, this is something that could last for a few years. I mean, it's not going to last 3 to 5 years, but this period of gold miner fundamentals being really strong and maybe exceptionally strong, this could really run for the next year or two, but not necessarily 4 or 5 years. So I'm talking about just the pure fundamentals. So enough of me talking here. Let's get to the video and some charts. Okay, so if you follow my work, you know that gold against the CPI is the best indicator for the gold miners. This is the best historic index of gold miners, the Barron's Gold Mining Index. I have data for this that goes all the way back to the 1920s, actually. But we can see here, just look at the shapes of the gold stocks here historically and compared to gold against the CPI. I've showed you before in other videos. I'll show you real quickly. Big moves up here. Then we have this depressed period here. We can see. Then you had the 01 to 11 period. Then you had the move down. And look, it's even been similar in the last 8 or 9 years, where you had this big move up in 2016, then you had a consolidation for a couple of years, then 18 to 20, another move up. Then, of course, the 2020 to 2023 period, where gold was consolidating close to its high, but the inflation-adjusted gold price was down considerably. And of course, the miners were down considerably. This index, I mean, Newmont is a heavy percentage, but gold stocks really, they move more like this. They had a bigger drawdown than this index shows. But I'm babbling on here. But the bigger point is these two follow each other. It makes sense because the cash flow of gold miners, or I should say gold divided by the CPI, and how this moves reflects the cash flow and cash flow potential of the mining companies. And so what's going on here, this data is a little bit delayed because we haven't got the CPI, I think, for March. But if I factor in a 3% CPI and look at where gold closed today, this baby is up above 9.5. So we're clearly at a new, last week we made a new weekly all-time high here, a new monthly all-time high. So this is a 45-year huge base, cup and handle pattern. This is a massive breakout. So this is telling us that margins could get even stronger in the next year or two. So that's scary, because if we get into this and look at some numbers, so I crunched the numbers, I looked really closely, and based on gold against the CPI, since the low in September of 2023, the real price of gold is up nearly 60% in the last 18 months. And again, this is what gold stocks follow. They follow the real price of gold, gold divided by costs or gold divided by inflation, far more so than they follow the gold price. So this is a hell of a gain over the last 18 months. But think about what we just showed in the last chart. The inflation-adjusted gold price has just broken out of a 45-year base. So this is telling us that margins and miner fundamentals are likely to get even stronger in the coming quarters, in the next year or two. And so to give you an example, I mean, just think about average junior miner or miner. So 18 months ago, if they were cash flowing $800 an ounce for every ounce they produced, now that's up to $13.50 an ounce. So what happens when the inflation, this is just broken out, what happens to this? So the margins that companies are generating right now, these could get even better in the next year or two. And to talk about my premium service a little bit, the top 10 companies we're looking at, the watch list companies, the ones that are building mines or they're growing production, I mean, you guys know, you subscribers know, some of these companies, they're going to generate some insane cash flow numbers in the next few years. And so, look, people, that's why if you're not a subscriber and you own minors and juniors, you really owe it to yourself to become a subscriber. We cover the highest quality juniors that we think that have the highest upside potential. So we're trying to max out highest quality and upside potential. So look, we've had a great last year. We're really happy with our stocks, but the way things are setting up based on the minors, based on the juniors as well, I mean, this, what we've seen in recent months, and particularly in the last month, this is just the start. I mean, this sector could really fly over the next year or two. And the technicals bear it out. Pure technicals bear it out because look, they're breaking out of 5-year long bases. I mean, look at this. This is the Canadian GDX. So if you remove the strength of the dollar, this is broken out of a 14-year long base. So people, it all bears out. I mean, the main point of the video today is that the fundamentals for miners are red hot and they could get white hot when we're into 2026. Now, with all that being said, as I've said in the last few videos, gold price, I mean, we're setting up for at least some kind of correction here. And so we're looking at, this is a quarterly chart of gold in the RSI. So I'm just marking the other points when the RSI got to this level of 82.5. So right here, right here, right here. So look, I mean, this is part of my gold bull analog where I look at cyclical bulls. I look at this move, I look at this move, I look at this move, or really this move here, and then this move. So these secular bulls had two really, really strong cyclical moves. And so we're right back there. And you know what happened here? This is 1972. We broke out from an all-time high, a little bit of a pullback here. Then we had, this was a blow off top since the end of the secular bull. And then we had this in 2006, where I think gold corrected like 20 or 23% really quickly. And then it just gradually trended higher until breaking out in late 2007 when they had to cut when the financial crisis started. So yeah, we're at a similar point. I mean, my thinking would be, I think we'll get a pullback. I think this is the best comp, 1972, 1973. I don't think we're going to have a blow-off move right now, and I don't think gold's going to correct 20 or 25%. So look, this is nuance. We have to understand. Fundamentals for miners are really strengthening. They're excellent right now. They could get white hot in the next year. But right now, this day, going into spring, going into April, things could pull back and soften because we're so overstretched. It's a good thing. It tells us the market is going to move much higher later this year, but we do need a rest first. Now, finally, this inflation-adjusted gold price, as far as being an indicator for gold stocks and gold miners, it also works for silver stocks. So this is silver divided by the CPI. This is SIL, the silver stock ETF. I mean, look at how closely these are following each other. Pop, pop, another big pop here, decline here, decline here. And here we have the last 5 years. And the stocks, I mean, this is also true for the gold stocks. They're running a little bit below where they should be. And that's because valuations and sentiment is starting to catch up, but it's still a little bit low. So miners, based on these indicators, should be trading higher. And this actually right now is probably, you know, when this is updated, it's probably right here, really close to where we are. So as far as the silver stocks, this just tells me that we really need to see silver break 35 to 37. The inflation adjusted price will move like that when that happens. So that's where we are. But that's it for the video today. There's just a couple things to keep in mind. Number one, fundamentals for miners are absolutely excellent right now, and especially quality junior miners. These companies that are growing production and building mines, they don't even need the gold price to keep moving higher. Even if margins dip 5 or 10%, they're still going to be generating huge amounts of cash flow and adding tons of value to their stock price over the next year or two. Second thing is the inflation-adjusted gold price has broken out of a 45-year base. So this really, really good situation, this could get even better in the next year or two. So don't be scared of things being too good. Now, remember what I said, it's not going to last 5 years, but this white hot fundamental trend, it can last another year or two. And finally, we are stretched in the short term, particularly the gold price, not as much as silver and the gold stocks. So we are stretched. There is a period where the market can rest. You don't need to rush into anything, do anything reckless. Just realize there's going to be breaks, there's going to be pauses and little corrections in between this strengthening trend and this strengthening bull market. So that's it for the video, today's Macro Mondays. I hope you enjoyed it. Let me know what you think. Please leave a comment. Thank you so much for tuning in. And I believe I'll have our monthly wrap up with Professor Vince Lancy, coming up in the next few days. Thanks, everybody.